Welcome back. Right now, something important is unfolding across crypto, and most people will miss it until it has already passed. Not because the details are hidden, but because it doesn't look dramatic. It doesn't arrive with massive candles, trending posts, or loud price forecasts. Instead, it's moving quietly, methodically, and intentionally, exactly how serious capital prefers to operate. At the moment, crypto is noisy. Social platforms are overflowing with fear, irritation, and uncertainty. Prices are moving in ways that feel illogical to most observers. Narratives change constantly. One moment claims crypto is dead. The next insists it's unavoidable. And inside all that disorder, most retail participants are watching the wrong signals. They're watching price. Large capital is not. What major money tracks is positioning. And positioning always occurs before clarity becomes visible, not afterward. Institutions don't chase excitement. They don't wait for consensus. They front-run structure, policy, and access. And that's precisely where we are now. For years, crypto inside the United States existed inside a regulatory fog. No explicit rules, no firm lines, just enforcement actions, lawsuits, and agencies colliding with one another. That environment didn't only frustrate retail investors, it completely shut out pension funds, insurers, and major asset managers. Not because they lacked interest, but because they couldn't legally justify participation. That phase is ending. Concrete legislation is moving through the U.S. system right now that directly addresses digital asset market structure, not a draft, not speculation. Real lawmaking heading into formal Senate markup early next year. This legislation does what the market has waited on for years. It defines regulatory responsibility, asset classification, and the standards exchanges, brokers, and custodians must follow. That might sound dull. It might sound technical, but this is the moment markets wait for. Because when rules shift from vague to defined, capital doesn't hesitate. It prepares, it positions, it moves quietly well before headlines celebrate adoption. And this is where people misread the signal. Most retail participants assume institutions enter only after regulation passes. That's incorrect. Institutions position before finalization once direction is clear enough to remove existential risk. Markets don't wait for certainty, they move on probability. And probability is shifting now. That's why sentiment and underlying activity feel disconnected. Why price behavior feels strange. Why fear narratives feel loud while positioning remains steady. That tension isn't random. It's typical during transition phases when one regime ends and another forms. And when you examine which projects align structurally with that transition, one name keeps surfacing where it matters: XRP. Not on social feeds, not in meme cycles, not in influencer forecasts, but in regulatory dialogue, institutional discussions, and infrastructure planning. You don't need to believe in XRP as an investment to notice something different is happening. While many crypto projects are still battling regulators, arguing classifications, or attempting to stay outside the system, one company spent years doing something less flashy, positioning itself inside the system. That distinction matters more now than ever. This video isn't about claiming XRP is guaranteed to win. There are no guarantees in markets. Anyone saying otherwise is selling reassurance, not reality. This is about understanding how large capital behaves and why the most important changes often look invisible while occurring. Because by the time regulation is crystal clear, institutions speak openly, and price responds decisively, the quiet accumulation phase has already ended. That's how markets function. So instead of asking whether price moves tomorrow or next week, the smarter question is this: why are the foundations shifting right now? And who is already positioned for that shift? That's what we're going to break down step by step. To understand why this moment matters, we need to slow down and examine the legislation itself, not using legal language but in practical terms. Because for years, crypto regulation in the United States wasn't regulation at all, it was enforcement. No clarity, no lanes, only lawsuits, retroactive penalties, and agencies competing for control. That environment created disorder. Under enforcement-driven regulation, nobody knows their standing. Exchanges don't know which assets are securities. Projects don't know which regulator oversees them. Custodians don't know which standards apply. And for institutions, that uncertainty is a complete stop. They don't deploy capital where rules can shift overnight. This is exactly what the Digital Asset Market Structure and Clarity Act is meant to resolve. At its core, this legislation does something simple yet powerful. It draws a boundary. It clearly separates the roles of the SEC and the CFTC. Instead of overlapping and fighting over jurisdiction, spot crypto markets where assets are traded directly are placed under the CFTC. That alone is a significant shift, because the CFTC oversees commodities markets, not speculative securities. Why does that matter? Because commodities regulation focuses on market integrity, transparency, and fair access, not constant disclosure obligations designed for equity issuers. That difference changes participation and structure. Under this framework, exchanges, brokers, and dealers must federally register. Custody rules are formalized. Disclosure becomes consistent instead of arbitrary. This isn't about restricting access. It's about making crypto readable to institutional capital, and institutions require readability. This is where timing gets misunderstood. The market isn't waiting for the law to fully pass before reacting. The moment it becomes clear regulation is moving from chaos to structure, positioning starts. Senate markup is scheduled. Lawmakers express confidence publicly. Direction is no longer speculative. It's procedural. Markets don't wait for signatures. They move on trajectory. This shift also explains why court cases are no longer central. For years, legal battles were treated as deciding factors. But legislation overrides litigation. A clear framework unlocks more capital than any single ruling ever could. And this is where XRP becomes impossible to dismiss. While most crypto companies spent years fighting regulators, Ripple chose a different path. Instead of avoiding the system, they leaned into it. They built compliance teams. They engaged policymakers. They structured operations around eventual clarity rather than short-term freedom. That approach looked slow. It looked restrictive. And during hype cycles, it looked like weakness. Now it looks like preparation. As regulation solidifies, projects able to operate inside defined frameworks gain immediate advantage, not due to hype, but eligibility. Institutions don't ask if an asset is popular. They ask whether they're allowed to touch it, custody it, and integrate it without legal exposure. Most crypto assets can't answer that cleanly. This is why market behavior feels disconnected. You have volatility, emotion, and retail frustration on one side, and quiet institutional readiness on the other. These worlds don't move together. They never have. When retail is loud, institutions are silent. When institutions speak, retail is late. And the key point is regulation doesn't create value alone. It creates access. Access to capital pools previously excluded, pensions, insurers, sovereign entities. These players don't gamble. They allocate according to rules. The Clarity Act doesn't guarantee success, but it changes the field. It moves crypto from gray zone into regulated infrastructure. That transition always favors assets designed for systems, not avoidance. This is where theory meets execution. Regulation alone doesn't move markets. Positioning does, and positioning only occurs when institutions believe an asset can function without legal or operational risk. That filter eliminates most projects. And that's why this moment matters. Ripple didn't wait for friendliness. They prepared for definition. While others treated regulators as enemies, Ripple treated them as stakeholders. That distinction sounds minor, but in finance, it's everything. You don't get invited by fighting. You get invited by proving functionality. The approval of Ripple's National Trust Bank application in the United States isn't symbolic, it's structural. A federally regulated trust bank isn't a loophole, it's direct access to U.S. banking infrastructure under federal oversight. That changes capability, clientele, and capital movement. Many underestimate this. Institutional custody is one of crypto's biggest adoption bottlenecks. Institutions don't want exposure unless assets can be custodied, settled, and reported compliantly. By becoming a regulated trust entity, Ripple removes friction, compliance becomes embedded. And when compliance is embedded, scale becomes possible. That's why institutions don't need hype. They need infrastructure, they need clarity, and they need counterparties regulators trust. Few crypto firms can offer that. Ripple can. Now observe institutional language once that threshold is crossed. When pensions and insurers show interest, it's not belief, it's eligibility. These entities allocate by mandate, risk, and legality. That's why ETF flows matter, not as price indicators, but as positioning signals. Capital entering through regulated vehicles often moves off exchange. It doesn't hit public order books. Retail sees price stagnation. Institutions see supply absorption. This disconnect confuses people because they expect buying to equal price movement. Large capital doesn't buy like retail. It accumulates quietly. It spreads execution. It minimizes impact. That isn't manipulation, it's professionalism. This is also where rotation appears. Money has no loyalty. It ignores narratives. It moves toward clarity, settlement, utility, and system alignment. When those shift, capital reallocates. This isn't about winners, it's about fit. When clarity becomes the deciding factor, settlement assets gain appeal over speculative ones. What you're seeing isn't rush, panic, or euphoria. It's preparation. Markets always behave this way before transitions. Foundations are laid quietly. Participation expands slowly. By the time it's obvious, opportunity is gone. That's why this phase feels uncomfortable. It tests patience. It tests conviction. It exposes who understands structure versus price. Financial systems don't change through revolutions. They change through integration. That's where narratives fail. They talk overthrow. Reality absorbs what works. Legacy systems upgrade. They layer. They minimize risk. That's why partnerships matter. When traditional networks adopt blockchain capabilities, they aren't surrendering. They're modernizing. And those upgrades are built to work with existing rails. Interoperability always beats replacement. This is where XRP aligns. Ripple never aimed to destroy infrastructure. It aimed to improve it. Faster settlement, lower friction, better liquidity. That objective fits reality. That's why Ripple appears in meaningful conversations. Integration scales through intermediaries, providers, and software banks already trust. Once enabled, expansion compounds, not explosively, but steadily. Infrastructure signals don't excite. One bank doesn't move price. But stacked integrations create tipping points. Retail expects announcements to move markets. Institutions expect reliability. When systems work quietly, they stick. That's the moat. XRP's role is misunderstood. It isn't consumer excitement, it's background function. Assets like that don't trend on hype, they trend on throughput. Throughput rises when regulation allows it. That's what's aligning now. Regulation, access, infrastructure. None guarantee outcomes. But they explain quiet positioning. People ask why price hasn't reacted. That assumes price leads adoption. In system assets, price lags. Permission first, integration next, volume after. Price last. Impatience causes damage here. Markets don't reward understanding instantly. They reward it eventually. The gap is where people abandon their thesis. So when you hear front-running, don't think conspiracy. Think preparation. Think entities allowed to move earlier because they understand system change. When you remove noise, it becomes clear. This isn't chaos. It's transition. Regulation is forming. Direction matters. Institutions move on probability. That threshold is crossing. Ripple is no longer an outsider. It embedded itself inside the system. This isn't about lawsuits. It's about eligibility. Infrastructure is upgrading quietly. By the time it's obvious, the work is done. That's why positioning feels silent. Price feels disconnected. Emotion dominates feeds. Serious capital stays calm. The market isn't confused. People are. And the uncomfortable truth is, markets don't reward urgency. They reward preparation. They reward patience. They punish the need for validation. That doesn't guarantee success. Execution matters. Policy can shift. But the behavior you're seeing is exactly how markets act when clarity forms before visibility. You don't need to panic. You don't need to chase. Watch the foundation. Watch the rules. Watch where capital can operate legally. That's where real signals exist. And finally, remember, this content is educational only and not financial advice. Always do your own research.